Hi, Steve Van Metre here, and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Still don't make any sense. Today, we're going to take a look at how hedge fund managers are positioned like we do every Monday, and I'm going to show you a research mistake I made, but not one that's actually bad. When I figured out the mistake, it turned out it was actually in our favor, which is pretty cool. I'll show you exactly how I made the mistake, and then we'll go forward and fix it. I've got a lot of stuff I really want to look at, so let's just get right into this. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by a seller or any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I own and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. All right, let's clear that out of the way, and let's go right into. Oh, you know what? There is one chart I did not have ready, but let's put it on here, and away we go. All right, let's start with the NASDAQ McClellan Summation Index, or the proxy for market liquidity. You can see it's in negative territory. That usually when it falls below zero, it starts to suggest that the plumbing's clogged up and stocks are going to drop. Now, we've had two drops in the minus 300 range and no real sell-off, but still it suggests that things should go down. And generally when it gets down in this range, it starts to sell off, but it hasn't quite happened yet. But let me get right into the big mistake. At least I say it's big. It's not really huge, but you might remember this chart from Friday of the U.S. Treasury and agency securities, and we noticed this dip here, and that kind of suggested that dip was correlated with the drop in Treasury yields, which are shown inverted here. One of the problems is when we go, where I was pulling this data was from the H.8 data, which we'd also look at every Friday. No drop, none. There's no indication of any drop in Treasury and mortgage-backed securities or Treasury and agency securities. Doesn't matter. None. So I thought, I think I mentioned Friday that maybe this has to do with the Fed repo operations, and they pull this off when the banks use these as collateralized loans. No. What I had to do to figure out this mystery is I went down here and I clicked on this to give me the data source. Now, you'll remember here, you can't click on anything other than the footnotes, and the footnotes don't take you anywhere really important. They just kind of say what this is. It doesn't say where it came from. But over here is where it came from, and it came from a memorandum. See right there, it's highlighted. The one we wanted is up here. Now you say, well, gosh, Steve, how could you make such a silly mistake? I can tell you exactly how I did it. Because you cannot pull up the chart from here, what I did was I put in the search engine, FRED database, U.S. Treasury and agency securities, mortgage-backed securities, all commercial banks. They didn't put memorandum in. So that one's going to be removed from our look every week. And now we're going to go to the correct one, the Treasury and agency securities, a mortgage-backed at all commercial banks. And those are shown in blue. And on a year-over-year basis, what we can see is the banks are accumulating mortgage-backed securities at a rate in excess of 10% over a prior year. And when banks buy mortgage bonds, interest rates go down. And so what I did is I took 30-year interest rates, inverted them, and now you see the proper chart. Now you'll also notice that pretty much from the onset of this data, banks have been buying, for the most part, Treasury and agency securities on a positive rate over the prior year. Again, except for this little dip here between, looks like 2013 and maybe 2014. But beyond that, what you can see is banks are accumulating massive amounts of mortgage-backed securities. So any dips in the data that we might see would indicate buying opportunities. So at the moment, the other data sort, it didn't even apply. That dip had really, the memorandum had nothing to do with what we were looking for. If you're really curious, we can go look at it, but it doesn't really matter. This is the proper chart. And so once again, the data backs, you want to buy bonds because it is the banks that are buying massive amounts of these. Now you want to know why. Again, they just don't have high quality collateral. So they're buying U.S. Treasury bonds and they're buying mortgages. That's pretty much what they can get their hands on. Obviously, U.S. Treasuries are their primary. Why are they buying mortgages? Because the Fed's selling them. Remember, these are those same garbage mortgage bonds that took out the economy in 2007 and 2008 and 2009. These are the same ones that the Fed bought. Now the Fed said, hey, we don't want this trash anymore. You can have it back. Well, guess what? Market doesn't really want it. The banks do, or at least they're buying it. And as the banks buy more mortgage bonds, they don't need to go out and do new loans to get more of them, because they've got a fresh supply coming from the Fed practically on a monthly basis, because the Fed is committed to unwinding their mortgage-backed security portfolio. So as the banks get more mortgages that they don't want, interest rates go down. Okay, so let's go on to talk about crops. There's a big cold front with by the end of the week, so you see this is a 6 to 10 day. There it is, 6 to 10 day. There's going to be frost, snow, potentially blizzard-like conditions in various parts of the Midwest. This is very important because when frost hits crops, they stop growing, period, end of story. And the harvest season is expected to start on around the 15th, so next week, and run into early November. I'm not sure how far because, well, no one's really sure at the moment. But this freeze is bad news, and there's nothing at the moment, at least in the weather reports that I've looked at, to show any signs that this is going to disappear. And again, this is what you get in solar minimums. You get delayed plantings, and then you get early freezes, and bam. What's crazy is the market isn't, pricing it in at all, and I find that somewhat baffling. I'm just going to go pull that chart back up. I clicked a little too quick. So all right, we'll go look at this while that one's loading up. This is the Treasury deposits with the Federal Reserve. The Treasury has added about $100 billion, maybe just from the estimated taxes that they pull in September, since this is now the September data. It's still not the big borrowing binge that needs to drive this thing way up into here. So the big liquidity pull from the U.S. Treasury has not happened yet. Let's take a look at how hedge funds are positioned. See how we're doing on time. I'm talking fast, so that's okay. All right, 10-year Treasury yields. You can see last week the yields came back near their recent lows, and hedge funds backed off a bit of their speculative positioning. Just because they backed off a little bit doesn't mean the market is very short bonds. Market is very short bonds, but remember, yields don't bottom till hedge funds are in, mean they are buying. So when they're long, then you start to get near a bottom. Same with 30-year, which is even better news because this is following the risk level that we're looking at by taking on more duration last week with the portfolio rebounds. You see that they extended their short bet on 30-year treasuries. And again, these don't bottom until the hedge funds go long. You'll notice boom, boom, boom. Well, this has got more to go, quite a bit more. So that's great news for us. Again, as I mentioned in the update on Friday, there will probably be some volatility over the next couple of weeks. It's to be expected. Anytime you put a trade in, things, it's not like they just go straight up. There's going to be some volatility. Take a look at oil. You want to know why oil prices are high? Again, very long speculative positioning by the hedge funds. They are very, very bullish on oil as it fell to $52 a barrel today. I know a lot of people say that oil is not going to go down. When these speculative bets start getting unwound, it will go down. A lot. Way more than anyone thinks. I mean, look back here. When it got down into around 30 a barrel. See the big difference in positioning? That's who's propping it up. As far as the S&P goes, they're fairly neutral but on their positioning here. And let's see, Euro we don't look at. Gold futures extremely long on gold. Some people say, oh, this little pullback here means it's time to buy. No. The smart money is down in here. There should be one big pullback. We'll have to talk about this again at some point. But the fact is, when you see the St. Louis monetary base going down, as it did when we looked at it last week, so the next update won't be, they update it every other Thursday, so it won't be till next week, I think we get to see it. I'll double check. Anyways, as long as the money supply is going up, and the monetary base is going down, gold should go down. Should happen. Not a buying opportunity, but it will be. It will be a big one. Let's see. They picked up their longs on the NASDAQ a little bit. Not a big deal there. And backed off a little bit on their small cap shorts on the Russell 2000. Take a look at US dollar. They increased their longs. This actually does, one of the few trades they're in that makes sense is long dollar. But check this out. Volatility futures, they are nearly way short, almost as short as they've been. This is a record short was back here, and then boom, volatility took off. Now look, they're almost back down to their near record short positions, going into two key events coming up. One is a big liquidity drain from the U.S. Treasury borrowing, hundreds of billions of dollars. Number two, third quarter earnings start on Tuesday. Market thinks they're going to be awesome. I don't think so. We'll talk about that another time. Now let me show you a chart that I had an idea for this week, and I was trying to think about, how do we know the payroll stuff is over? I mean, how do we know if we're really kind of at the peak? We saw the slowdown. The market doesn't really believe that it's a real slowdown in payroll, and so I was thinking about if I could grab the working age population. So I went to the internet and I typed in Fred database, working age population, and boom, there it is. Okay, 15 to 64, all persons in the United States. And then I wanted the non-farm payroll report, but the non-farm payroll report was in thousands of persons, so I multiplied by 1,000. And then I divided the two to create a ratio just to give me a historic idea of how these two interact. And I thought it was very interesting that there was a 1.35 ratio of working age to employed at the, whoops, that I didn't want either. Let's see if we can zoom. Oh boy. No. There we go. So looking back at the dot-com bubble, which was really, in a lot of sense, peak employment. And you can see then, going into the great financial crisis, there wasn't as many people employed. But I think most people know that. But look at today. You have pretty much the same ratio. This thing got as low as 1.34, and here we are at 1.36, just telling us that this market, in terms of employment, is done. I understand there's people listening that have friends, family members that aren't working. I totally get it. But just based on this relationship, it says we're there. All right, let's see what time we got. A few minutes left. Let's hit some charts, and I'll get rid of that out of the way. And so the S&P 500 broke back down through its 50-day moving average, closed just slightly under the support level. Not a big deal. Somebody was saying today the markets are barely up over the last year. That is true. A lot of investors are taking a lot of risks. They probably make more money in CDs than some of the risks they're taking buying stocks way up here. But that is their call. Let's take a look at the Russell 2000, which we looked at on Friday. That is trying to, we'll zoom in a little bit, is bouncing off the support level. The question is, how high does it rally up? And does it break? When does it break support? It's not a matter of if, it's just a question of when do buyers run out? They will at some point. And along those lines, let's take a look at 30 or 10-year treasury yields, the chart to watch. You've got people that have been shorting this for the last 7 years, actually a little over 7 years. They shorted it heavy here. They shorted it heavy here. The question is, now look, they don't have as much ammunition. The buyers are in, the commercial banks, the securities dealers, the Fed. People are buying treasury bonds. The question is, when it comes down here again to this roughly 1.4% range, will they have any ammunition to sell this thing up? Or will liquidity be in the markets be so dry that this collapses? It triggers a big stock market crash. You got to look at this and say, man, you got to love bonds in this scenario. Now, one of the things you'll hear traders say is you buy the breakout, meaning you would wait until this cracks 1.4% before you buy. So the question is, why would we buy a little ahead of that? Well, the problem is, other traders who are very, very familiar with the bond market will say, yeah, good luck trying to catch that move because you can't. By the time the bond market goes, it's done. And here's the example. Here is the breakout going into 2008 and 9. boom, this is weekly, boom, 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 done. 1, 2, 3, 4, 5 weeks and over. If you're buying in here, you're chasing this thing. If you're hesitating, well, maybe, okay, too late. You have to buy this thing early, trust your data, and wait. And that's why I said my update is going to be some volatility because, well, there's going to be some volatility. The market wants yields to go lower or higher, but it's going down. And you kind of look at evidence of that. Here's crude oil. Today, it's closed at just under 53 a barrel. So how is that inflationary? It's not. How do you get higher yields when oil prices are falling? You don't. Oil tells you if there is inflation because it usually rises. And when you see all the speculative long positions in there, you kind of know yields are headed lower. So maybe this week, as the markets adjust the 3-year auction tomorrow, 10-year and 30-year, Wednesday and Thursday, I expect toward the end of the month, the yields will be headed back down. It may not even be until the next month where we get the next pay report where this thing really goes. I don't know, but all I know is the setup is there, and you can't miss out on it. So I'll be back Wednesday, and we'll see what we've got in the markets then. I'm Steve Van Metre. Thanks for watching. Bye now.